All right, good afternoon, everyone, and welcome to today's webinar. My name is David Von Eiff. I'm a director with the CFA Institute in the Research Advocacy and Standards Division. And our other speaker today will be Elka Zhou, who currently serves as the Associate Director of Ratings at CSPI Ratings, where she is primarily responsible for credit rating and research related to general corporates, including LGFEs, automotive manufacturers, and machinery. She has a long-standing focus on corporate financial conditions, industry development trends, and credit risks, and she possesses robust analytical skills and extensive project execution experience. Elka has authored numerous industry reports addressing topics such as credit risk analysis, changes in industry structure, and corporate financial performance. Her findings have been widely cited by various domestic and international financial media. She has over 15 years of experience in the financial industry and is well versed in credit rating, financial auditing, and corporate valuation processes. And prior to her current role, she had positions at the Big Four accounting firms, both domestic and international rating agencies, and large security companies, where she participated in credit assessment and due diligence projects for numerous large enterprises, accumulating a comprehensive foundation of professional knowledge and practical experience. So I think today's webinar will be very informative. And I know we have a short time, so I'll hand it over to Elka.
Oh, hi, David. Thank you very much for the kind introduction. And hi, everyone. I'm Elka from the Analyst team at CSPI Ratings. It's a pleasure to be here and to share some key insights from our latest credit outlook on China's new energy vehicle industry. And before we dive into the outlook, let me take a moment to briefly introduce CSPI Ratings. CSPI Ratings is a Hong Kong-based Chinese international credit rating agency licensed by the Hong Kong Securities and Futures Commission and recognized by the Mandatory Provident Fund Schemes Authority. We offer world-class credit insights from a Chinese perspective, serving as a gateway for foreign issuers and investors into the China's financial ecosystem. And also, CSPI Ratings is a full subsidiary of CSCI Pengyuan, which is a top 3 credit rating agency in China. And let's turn to today's webinar. In today's session, we'll focus on 4 key dynamics. First, we'll start with a brief overview of China new energy vehicle sector. And second, let's discuss the rapid industry evolution from electrification to driving intelligence. And then we'll analyze the possible fallout from sustained price competition among new energy vehicle makers. And finally, we'll share our credit outlook for China's new energy vehicle industry heading into 2026. I think before we get into all that, let's take a quick look at what's happening globally. Since 2020, the global new energy vehicle the new energy vehicle market has entered a phase of rapid expansion with a compound annual growth rate of nearly 50% from 2020 to 2024. And this growth is driven by a confluence of factors, including broad-based policy support, subsidies and tax incentives, as well as technology breakthroughs in lithium-ion battery systems. Passenger vehicles dominate this segment, accounting for over 90% of annual sales. Regionally, we noticed that China leads with about 70% of global volume, followed by Europe at around 20% and North America at around 10%. And this geographic variation also reflects different levels of policy intensity, infrastructure readiness, and OEM strategies across the markets. In addition to annual sales, we also focus on market penetration rate, which usually serve as a key indicator as consumer adoption and structural transformation in the automotive industry. So the global average new energy vehicle penetration rate has risen from 4% in 2019 to around 20% in 2024. But market development, as we look at the graph, remains uneven across regions. China's penetration rate surged from 4% to nearly 50%, far exceeding the global average. Europe shows wider internal divergence, and the North American market and Japan lag behind. And let's turn to the Chinese new energy vehicle market in 2025. We focus on several key developments. To begin with, the overall new energy vehicle sales remain robust throughout the year, underpinned by both policy support and market forces. From the policy perspective, the nationwide trading scheme introduced in 2024 remained in effect through 2025 and supplemented by some regional consumption stimulus programs. We believe that these promotional and subsidy measures substantially enhance consumer willingness to purchase the electric vehicles. On the other hand, technological maturity is reshaping the consumer perceptions. Advances in electrification are alleviating concerns around range, charging speed, and safety. And at the same time, smart driving features, once confined to premier models, are increasingly available in mass market vehicles, accelerating the broader adoption. The second feature in 2025 in China's new energy vehicle market is that the growth trend split by power type. We noticed that for the first time in 3 years, battery electric vehicles or BEV, the BEV growth outpaced plug-in hybrids, or PHEVs. And we believe that this shift has been driven by rollout of some low-cost BEV models and expanding charging infrastructure. So taken together, policy support, technological advances, and shifting consumer preferences are reshaping the overall new energy vehicle landscape in domestic market, pointing to new opportunities and challenges as we move into 2026.
Thank you, Elka. So I think that was what you have for the first section. Is that correct?
Yes.
Yep. So I have a couple of questions for you, if that's okay. So as you mentioned, China's NEV sales have been surging, and that's, as you mentioned, about 45% of domestic auto sales by mid-2025 and about 70% of global NEV sales. How sustainable is this kind of rapid growth? And do you anticipate any, say, market saturation or emerging headwinds, for instance, say, China's high base effect or changing subsidies abroad that might moderate this pace in 2026?
Yes, from our perspective, we believe that China's new energy vehicle market has expanded rapidly. And over the longer term, it is expected that the penetration in China could rise towards 80%. But also the pace of growth will naturally moderate as the high base effect makes incremental gains harder. Growth will also be determined by other factors such as policy support, consumer acceptance, and smart technologies. Globally, electrification trends remain intact, but headwinds are emerging. The gradual phase out of subsidies in Europe and the US, potential trade frictions, and intensifying competition may slow this momentum. Thus, while we believe that China's leadership in new energy vehicle market is sustainable, 2026 is likely to mark a transition from the explosive expansion to steadier growth, driven more by market fundamentals than policy incentives. Thank you.
Okay, I think that's an interesting shift to note to that market incentive versus policy. Okay, and the report also noted, and you noted as well, that battery EV sales have, for the first time, outpaced plug-in hybrids, aided probably by the low-cost models and the expanding of charging infrastructure. Do you think this signals a longer-lasting consumer shift towards pure EVs over hybrids locally? And what do you think is your outlook for overall NEV sales growth in 2026, especially with policy ports like tax exemptions being partially scaled back?
Um, Automotive consumption currently accounts for about 10% of total retail sales of consumer goods in China. So, we believe that relevant consumption stimulus policies will carry over and continue to support market growth in 2026. And China's penetration rate of new energy vehicles expected to exceed 50% in 2025, with another 3 to 6% increase in 2026. But due to the high base effect and the changes in purchase tax exemptions, the overall growth rate in 2026 will not be as higher as in 2025. And regarding the divergent trend between the BEV or electric vehicle and plug-ins, it is still unclear how long and to what extent the shift will last. And looking ahead, PHEVs will face tighter tax credit requirements starting in 2026, and we believe that this may reshape product strategies and consumer preferences in Chinese domestic market. But we also noticed that PHEVs perform strongly in some overseas markets, such as some countries in Europe, because where the carbon emission targets are stricter, but the BEV charging infrastructure still lags behind.
Okay. All right. Those are the questions I've seen for section one so far. So let's go on to section two.
Okay, let's move on to the exports. Exports, we also see a standout year. China is the, I'm sorry.
Sorry, guys. Due to technical issue, right now I'm trying to adjust the speaker setting so that her image won't block the PowerPoint slides.
Yeah. All right. Yeah, I think it's better, I think.
Okay.
Yeah, this looks good.
Okay. Sorry sorry for that. Oh, let me see. I can't see myself. Sorry. Can you hear me, David?
Sorry about that. I was muted. Yes, I can hear you just fine.
Okay, let's move on to the exports. Exports also had a standout year in China in 2025. China is now the world's largest auto exporter, and new energy vehicle exports accelerated sharply throughout 2025. And from January to October, we noticed that over 2 million new energy vehicles were shipped abroad, up more than 90% year on year. And passenger vehicles still made up the vast majority of this volume. And export destinations became increasingly diversified. As we see, Belgium remained the top destination, serving as China's key distribution hub in Europe. Southeast Asia saw strong momentum, as well as Mexico, Australia, and the UAE, with the Philippines recording a 96% surge, reflecting the growing consumer acceptance of Chinese brands in these countries. Brazil, while still ranking fourth, saw a slight decline, largely due to intensifying competition and shifting policies in Latin America. On the other hand, trade risks are escalating. The EU's anti-subsidy tariffs, Mexico's proposed 50% import duties, and the US multi-layer tariff regime are reshaping export economies. And in response to these rising trade barriers, firms are shifting toward localized production. Companies such as BYD, SAIC, Chang'an, etc., have already set up facilities across key overseas markets, including Brazil and part of Asia and Europe. But compliance and cost burdens are also rising. So in short, China's new energy vehicle exports highlight both remarkable global expansion and mounting external challenges. David.
Thank you. So, as you mentioned, yeah. So you've seen Chinese automakers have a significant increase in their exports, nearly doubling in the first part of 2025. And that seems to be gaining traction in a diverse range of markets, including Europe, Southeast Asia, and the Middle East. So what do you think is behind strong international uptake? And which overseas markets or regions do you expect to be the most pivotal for Chinese EV growth moving forward?
Well, I think the answer to the first question hinges on my next section, but I can offer a slight hint here. I would believe that it is the rapid development of electrification and driving intelligence, and along with the fast model iteration and the strong supply chain synergy. These factors made China's new energy vehicle competitive in this international market. And as for future target markets, we believe that exports diversification will be key going forward, not a single market. But geopolitical uncertainty remains a structural headwind that the industry must navigate carefully.
Yep. Okay. And then I think, as you mentioned there's those headwinds. So we see things like rising trade protectionism or geopolitical tensions creating those external risks. And how serious are threats like potential EU tariffs or US import restrictions to this export momentum? And how do you think Chinese manufacturers could respond to these headwinds through maybe expanding overseas production, different kinds of trade alliances? Or are there other strategies that we might see to help mitigate these barriers?
So, as to the degree of threats, we believe that different markets may be affected in different ways. Let's take the US, for example. The direct impact of tariff is moderate, as China's new energy vehicles export to the US account for only a small portion of total exports. And among these, the majority are Sino-foreign joint venture models or US branded vehicles manufactured in China. However, the spillover effects may impact the broader Chinese automotive value chain. Key components such as power batteries, where China holds the highest global installation rate, could be affected by rising tariffs and trade restrictions. And As to the EU markets, the EU imposed anti-subsidy duties on some major Chinese OEMs in 2024 and later replaced by some minimum pricing mechanism in 2025. But as we see the Belgium's import volume continue to grow, we believe that the tightening EU policies may constrain the future expansion. As we mentioned earlier, some OEMs have already set up their production facilities, their sales center and R&D centers in the local markets to avoid these trade barriers. And this localized production and sales will offer a potential solution to tariff-related challenges. But we also believe that the regulatory compliance and management costs will increase. And in the long run, we believe that the shift also supports the long-term brand building and capacity spillover, laying the groundwork for deeper market penetration of these companies.
Okay. I think that's a very good answer. I think there's one more question that we have, but I think just given time, I'll hold it for the end so we can go on to section 3.
Okay. I think we can move on to the next topic, a deeper realignment in this industry, and then we can begin with the electrification shift. As we see, the power batteries account for over 1/3 of total vehicle manufacturing cost, and some key technical indicators such as energy density, faster charging capability, and cycle life directly influence consumer perceptions of range, charging efficiency, and safety. China remains the global leader in power batteries with steady growth in installations. And there are several notable trends in power battery sector in 2025. Firstly, we noticed that the market concentration among the top 3 players has declined slightly. And this shift is primarily due to the narrowing technology gaps across manufacturers. And we believe that it is also the increased support from OEMs for their vertically integrated battery partners. And second, LFP battery or lithium iron phosphate batteries continue to dominate the market, but we all notice that the new battery technologies are gaining traction. CATL, one of China's leading battery makers, unveiled a sodium iron battery in April 2025. In addition, both domestic and international battery manufacturers are showing strong interest in solid-state batteries, with pilot production expected between 2025 and 2026, and possible mass production by 2027. We expect that the competition in the power battery sector will remain intense. Technological innovation and large-scale adoption are set to serve as dual engines driving the next wave of market transformation. And with the electrification entering a more mature phase, the spotlight is now shifting to intelligence. And in 2025, competition in smart driving technologies is intensifying, driven by rapid innovation, regulatory momentum, and rising consumer expectations. There are also 3 key trends of smart driving technologies in 2025. Firstly, the penetration rate is accelerating. We have noticed that the penetration rate of vehicles with L2 and above assisted driver systems have exceeded 60%. And this growth is underpinned by some continuous enhancements in NOA system or navigation on autopilot, and as well as significant cost reductions in core components like LiDAR. And secondly, intelligent systems are expanding to lower price vehicles. The penetration rate has also risen to around 70% in Q2 2025 in the RMB 100,000 to 200,000 price range. And models priced below RMB 100,000 are also showing meaningful growth in adoption. And third, while the electric vehicle car makers remain the primary platform for intelligent driving, possibly due to their advantages in electronic and electrical architecture. Traditional internal combustion models have stepped up in recent years, narrowing the technology gap. In addition, from a policy perspective, China is now adopting a dual-track policy approach to balance the innovation with safety. We have seen that the regulatory authorities are actively encouraging innovation while reinforcing safety and compliance. For example, authorities have introduced a structured roadmap for L3 deployment. But at the same time, they have tightened some marketing language to better manage consumer expectations.
Yeah, that's a very interesting section. I think there's two main questions I see in the Q&A on that. The first being, like you mentioned, with the LFP batteries now making up over 80% of EV installations in China, and the falling battery costs that you mentioned, such as some of it is driven by the falling price of lithium carbonate. Do you foresee any of these emerging technologies breaking into the mainstream soon, like the CATL's new sodium-ion batteries? And what impact could they have on EV costs and on the key kind of competitive dynamics that currently exist among battery suppliers and automakers over the next few years?
Well, that's an interesting question, but in the short run, we believe that the LFP or lithium iron phosphate batteries will continue to dominate the EV markets. Emerging technologies will likely play a complementary role, contributing to diversification rather than immediate mainstream replacement. Importantly, we also noticed that the fast-growing energy storage sector also requires massive battery volumes, which means that these new chemistries could help ease supply constraints and reduce dependence on lithium if demand surges in the future. In addition, there's still no clear timeline for mass production of these new technologies, and their commercial viability remains uncertain. So for battery suppliers and for automakers, following mainstream technologies offer greater survival prospects. But the definition of mainstream, we believe, is itself evolving. So the significant R&D investment and capital expenditure will be required to bring these new chemistries to scale. In the next few years, the competitive dynamics of these battery suppliers and the automakers will hinge on who can balance the cost reduction, supply security, and technological innovation.
Okay, I think that's a very good point. Like predicting new technologies is always quite difficult. You also mentioned that advanced drivers features like the L2, L3 are quickly shifting from the higher end options to become kind of standard equipment across Chinese car models. How do you see this rapid normalization of vehicle intelligence affecting the industry's competitive landscape? For instance, do you think automakers will need to significantly boost R&D to stay kind of at that cutting edge? And maybe that leaves it harder for smaller players to keep up. And as traditional, say, petrol cars also adapt to more smart features, could this help them, say, narrow the gap with, well, the tech gap with EVs at least? And could that pose a renewed challenge to NEV in certain segments?
Actually, for new energy vehicle makers, we believe that the intelligentization is a double-edged sword. It boosts competitiveness and consumer appeal, but requires sustained capital and talent investment. Companies that treat it as a strategic differentiator and manage their technology well will likely strengthen their business profile. But those chasing features without scale or integration will risk cash burn or operational strain. In addition, as vehicle intelligence is accelerating, these software-defined vehicles are pushing suppliers and the car makers towards service-oriented model. Technological firms are entering the space with integrated solution, comprising the traditional manufacturer's margins and redrawing the value boundaries. So for OEMs and suppliers, a strategic pivot to software and services is becoming essential. But this shift also requires higher R&D spending, organizational restructure, and talent upgrades, the factors that may weigh on short-term profitability. Small OEMs may be affected more deeply as limited financial resources and weaker talent pools constrain their ability to invest, leaving them vulnerable to margin erosion and competitive displacement. We believe that over time, this divergence could widen the credit gap between leader players with strong balance sheets and small players struggling to adapt. And as to the second question, traditional petrol cars are becoming increasingly intelligent. Yes, and we also noticed that public data show that in several months of 2025, petrol car sales continue to rise, with the cumulative growth rate from January to August reaching 1.1%. Beyond some consumption side policy stimulus and the price competition, breakthroughs in smart features together with inherent advantages such as better adaptability for long distance travel and low temperature environments. These features have made traditional vehicles more attractive. So we believe that if these traditional petrol vehicles achieve major advances in intelligent technology. In a slowing automotive market, the substitution dynamics between traditional cars and new energy vehicles could become increasingly complex.
All right, thank you. I think those are very good responses there. I think we only have about 10 minutes left, so I'll hold any more questions to the end. So if we can go on to section 4.
Okay. With this strategic and market challenges in mind, we now turn to the financial and operational performance of representative new energy vehicle OEMs. The overall profitability of China's auto industry remains under pressure, primarily due to intensified and prolonged price competition. While this decline in some power battery material costs has provided the OEMs with greater pricing flexibility, it has also fueled deeper price cuts across the market. And the rising new energy vehicle penetration rates have supported the overall sales volume year after year. But as we see, OEMs remain highly sensitive to the risk of falling behind. For leading players, economies of scale and strong product value have sustained profitability. In contrast, many startup manufacturers are willing to sacrifice margins in exchange for volume growth and heightened brand visibility. And in our Outlook report, we selected a group of new energy vehicle OEMs to examine their financial performance. The sample focuses primarily on pure play new energy vehicle manufacturers, excluding traditional automakers. We believe that this approach allows us to better capture the financial and operational characteristics of the companies whose core business is new energy vehicle production. Unlike some diversified OEMs, these firms are more directly exposed to sector-specific dynamics, including policy shifts, raw material cost fluctuations, and intense pricing pressure. And from the charts presented in this sheet, most startups have yet to achieve profitability, making the sales growth and operational cash flow critical to assessing their financial health. And in this environment, we believe that companies with strong cash flow, brand strength, and scale will be better positioned to navigate the consolidation and withstanding rising competitive pressure.
Yeah, I think that's an interesting point you made on the margins. So in terms of how we've seen these margins get squeezed, do you expect this kind of aggressive price competition to continue into 2026? And if so, kind of what are those implications? For example, could it drive, say, industry consolidation or force some of the weaker, more unprofitable players out of the market if they can't find a way to improve those margins?
Well, we believe that the industry remains in, as we previously mentioned, in a rapid expansion phase. Product iteration is accelerating, and the economic scale are beginning to take shape. As Ford mentioned, car makers are sensitive to the risk of falling behind, but also in response to the anti-involution policy, some OEMs are shifting from pure price discounts to bundling value-added features at no extra costs. But we still think that the price competition will continue into 2026. And across industries, we noticed that from the startup phase to maturity, periods of excess competition are not uncommon. Mergers and acquisitions occur. Some players exit the market, while others expand and consolidate. Profitability will hinge on the scale and supply chain control. And from the perspective of new energy vehicle makers, overcapacity and uneven demand recovery are exacerbating the margin pressure, especially for small players with limited differentiations.
Okay. Yep. And I think there's one more question, but maybe we can go to the next slide first, and I think that'll help address it as well.
Okay. And I think we can look at where the market is heading and what it means for credit in 2026. Firstly, we expect that China's new energy vehicle penetration rate to exceed 50% in 2025, as we previous mentioned, with another 3 to 6% increase in 2026. Low-cost pure electric models are expanding into lower-tier cities, unlocking new demand. While policy support remains in place, the shift to a 50% purchase tax reduction in 2026 may introduce some short-term volatility. Globally, exports are emerging as a new growth engine. Chinese OEMs are building localized capacity in Mexico, Europe, and the Middle East to mitigate trade risk and get closer to end markets. However, geopolitical tensions and tariff uncertainties remain key external risks. And second, looking ahead to 2026, China's new energy vehicle industry is expected to enter a new phase of consolidation. Market concentration will continue to rise as ongoing price wars squeeze weaker players in the accelerated exit of less competitive brands. At the same time, relative low battery material costs will provide leading manufacturers with greater room to defend margins, while sustaining aggressive pricing strategies. Together, these forces point to a more polarized landscape. Dominant firms will strengthen their positions through scale, technology, and cost advantages, while smaller producers face mounting pressure. The result will be a more mature, concentrated market where competition shifts from sheer volume growth towards profitability, differentiation, and long-term sustainability. And finally, by 2026, advances in battery technology and vehicle intelligence will continue to drive the automotive value chain forward. Continuous improvements in energy density, charging efficiency, and material innovation will lower the costs and extend the vehicle lifespans, reinforcing the competitiveness of leading car makers. And at the same time, the integration of intelligent driving systems, connectivity, and data-driven services will shift value creation beyond hardware, opening new revenue streams in software, platforms, and ecosystems partnerships. So together, these trends will accelerate the transition from a traditional manufacturing-centric model toward a technological-enabled, service-oriented industry structure, positioning new energy vehicles at the center of a smarter and more sustainable future.
Yeah, thank you. And I think it's a very good conclusion. I think we have about 5 minutes left. So I think maybe one or two questions. So one of the questions I see has to go with kind of your perspective on the credit outlook. And I think your presentation and the report both suggest that companies with scale and stable cash flow will prove more credit resilient, whereas the more highly leveraged or low profit firms will face that consolidation or exit risk. So do you have any kind of advice for how investors can differentiate which automakers are better poised to kind of weather that storm in 2026 versus those that might struggle?
Well, as we discussed earlier, we focus on both the business profile and financial performance of an entity. The ability to balance scale, profitability, cash flow, and resilience against policy and market pressure is critical. And in addition, we believe that the credit strength will increasingly depend on the company's ability to manage their technological transitions. Firms that invest strategically in core technologies and adapt their business models will be better positioned to capture the long-term value.
Okay. And I think, as you mentioned earlier, we've seen that deliberate shift to letting market forces determine the sector's trajectory. So with those national purchase subsidies already ended and the tax rebates that we phased out in 2027, it's kind of a new era maybe for the EV industry. So against that backdrop, how do you think the gradual withdrawal of, say, government subsidies affects the sector's future growth and profitability, particularly for those small manufacturers?
Oh, well, it's a very big question. As we discussed above, China holds a dominant position in global electric vehicle manufacturing and supply chain. And it is also one of the largest EV consumer markets worldwide. The new energy vehicle industry remains in a rapid growth phase, but continues to face challenges such as overcapacity and intense competition. We expect that the production side subsidies to be gradually phased out, while consumption stimulus schemes are likely to resume in 2026. So though China has removed new energy vehicles from its next 5-year strategic industry list, as you mentioned, automobiles are still included. But unlike previous years when new energy vehicles are highlighted independently, the current focus has shifted mainly to the consumption side. And at the same time, we noticed that the inclusion of other power technologies in this list, such as hydrogen energy, indicates a move toward a more diversified new energy structure in the future. And as we discussed above, the market has already been shaped by policy and the market synergy. So in the next few years, the gradual withdrawal of government subsidies will further accelerate the market-driven reshaping of China's EV sector. Further growth will rely less on policy support and more on competitive differentiation, operational efficiency, and the ability to adapt to evolving consumer and regulatory demands. Smaller players with limited market share and weaker financial resilience will face mounting pressure as their margins compress and the competition intensified.
Okay, thank you. So I see we're at time, so I want to thank you for your presentation, and I think it was very interesting and some great insights into the NAV market. The slides will be sent out through the registered email to everyone as well, so you should receive a copy of the slides. And I want to thank everyone for attending as well. And again, thank you, Elka.
Thank you, David.
All right, and thank you,
See you
everyone.
next time.
Yes, see you next time,
Yeah.
guys.